All right, everyone, welcome back to another episode of No Bull with Noble. This is episode 14. Again, if you're watching, I'd want you to subscribe if you like it. Give us a like on whatever, YouTube, Spotify, 5 stars, Apple Podcasts, also 5 stars. I would really appreciate it. If you think it sucks, you can give me less stars, but I don't know. I guess whatever you like, whatever your opinion, just, if you're willing to support us, and I don't know, just help us out. Anyway, we have a very special guest today. I'm actually really excited. We have Zach Lofeudo on the podcast. Zach, welcome.
Thank you.
Welcome.
You nailed my last name too.
Got it. I got it.
I'm glad we did that sort of preamble before, the couple minutes before,
I
just
had
to get
make
that.
Sure. Yeah, that's because good. I didn't want to fuck anything up or have people have a different perspective of your name and me being the guy to fuck up your name. I mean, I guess it'd be a good meme, but.
That is. I mean, you're on episode 14. You got to get those little things down, right?
Did all my research beforehand.
That's good.
So Zach is a mortgage broker. So we're gonna dive pretty deep into some stuff with mortgages and for first time home buyers and what you think about the market and all of that. So I'm really excited. So welcome. I guess you can tell us a little bit about your journey before we start. Your background.
Yeah. So I've been doing mortgages a little bit over 3 years now. So started with a different brokerage that I'm at now. Learned the ropes from one of the top mortgage brokers out there, and was just able to kind of do a crash course university of mortgages within the first few months. See a crap ton of files to put it in lightly there. Prior to getting into mortgages, I came from the hospitality and restaurant background. I actually owned my own restaurant, and I had that really for 5 years in the East End of Toronto in the Beaches area. So I took all that same customer service level of hand holding kind of throughout the process, and that. All that from my previous knowledge of running a business and put it right into the mortgage biz. It took me a little bit to get going, like anything with real estate mortgages. You gotta build up especially change your brand from the restaurant guy to trusting people having people trust me with their biggest life transaction.
I mean, food is still important too.
It's very important. I could have got people sick, man.
Exactly.
So it's like they already had that little bit, I guess, of trust in me. But just to change over to the financial service kind of industry, but it happened I'd say quickly or slowly depending on how out of the gate you go with this career, but it took me about 8 or 9 months to really get things going, and then kind of just exploded from there. And now I've been able to help a ton of people across investment property buyers, first time home buyers, and everything kind of in between, downsizing, reverse mortgages, private, alternative. We can kind of get into all that later.
You've done it all.
But been able to see a little bit of everything, and now kind of finding my niche with different types of buyers out there and helping them.
Yeah, that's good. Starting from hospitality, I feel like there's so many people that start in hospitality, and I guess I did a little bit of it, but not in the same.
I think the leg up that I did have in starting is that I ran a business as well, and so many people don't realize they get their real estate or mortgage license or something that you're not just kind of a sole person doing your mortgages. You're operating a business, right? So that's kind of where I had that sort of mindset and cost control and everything, which is, I'd say, even more difficult in the restaurant industry, because you're also managing a bunch of depending on the size of your team. When you get into becoming bigger in real estate or mortgages, you might have a team, but having 10, 15 employees at a restaurant when half of them come in hungover, it's a little bit a little more tough, difficult to maintain the monkeys there. But no, it's good. I really did enjoy it, and I'm glad that I kind of went through that and then now transitioned into mortgages to have that knowledge of running a business.
Do you think you'll own another restaurant in the future? Or?
Maybe if I have a good front of house manager and a chef, and I can kind of just maybe bankroll it. I don't know. That could be something for the future. Maybe a 10 year goal. I might have a nice cool little hip spot on King Street or something like that.
Yeah, because I think that once you've done it, you sort of know. Yeah. You know the ropes. You know how it works, but. Yeah. I guess you also know the downfalls and the bad side of it.
100%. Yeah.
Well, anyway, I don't want to get too far off topic.
We can get into those first time home buyers.
Yeah, that's good. So listen, I want to talk about first time home buyers because there are a lot of people who are listening who may not have bought their first house or are just going through it, and I feel like the biggest thing, especially in this market, in the Toronto market, is budgeting, because the housing costs are through the roof. They're insane. The mortgage rates are going up, and it's so difficult for some people to not only qualify for a mortgage, but just be able to afford anything in this city. So I want to sort of touch on that. What do you think is something that someone can do to help budget themselves if they're thinking about buying a house for the first time?
100%. So, I mean, just starting out right from the basics, like create a budget. Because everyone says like, yeah, I'm going to budget and my goal is to buy a house, but you don't actually put pen to paper and say, this is how much I'm going to spend and really stick to that. Okay, so that's first and foremost, is putting together a budget. Then being more realistic with that as well. And like being realistic with the type of property that you're going to get into. It's probably not going to be a $1.5 million house in Roncy or something like that. It's going to be your first property purchase. And then also would be, if you can't afford it, say on your own, generally I'm not seeing a lot of single young people buying a home solo or buying a condo solo. So it's probably going to be with a partner where you have dual income coming in there, or with a family member or a friend or something like that. Like, it doesn't have to be a partner. If you're having these conversations with your friend groups about wanting to purchase property, that has a collective goal, right? And then you can work together towards budgeting and saving to get to that minimum down payment that you need to potentially buy a 2-bedroom condo or something together, or be realistic with your area and your search. It's probably maybe not going to be downtown Toronto core for you. That's going to be your first purchase, especially if it's with multiple people. If you're going to school or something with a bunch of other professionals, you get out of university, you all have entry-level jobs, but they still have decent salaries and things like that. Pool that together. Now you have multiple people with buying power, multiple people with saving money together, and then able to actually get maybe a house that has like a duplex or something like that, where you each even have your own space, or kind of sharing and getting into the market that way. Down the line, you have that equity growth, you have the advancement in your career as well, you're making more money, saving more, and then you can kind of sell and move that money around. Owner-occupied property, so you're not paying any like capital gains tax or anything on that down the line, even if you're buying it with multiple people. And then you can take your big chunk of that equity each and go eventually get into kind of your own properties. So that's really like being realistic, setting goals, working together with other people are really the first fundamentals there. And then when it comes to budgeting, this is something that maybe it's a little controversial, but it's actually easier to just go make more money. You know what I mean?
It's easy to say,
but honestly, it is easier to go, either get like a second part-time job or start a little side hustle or something that earns you $10,000 more a year than trying to save $10,000 more a year. You know what I'm saying, right? Yeah. It's like, because you're just not buying a Starbucks coffee every day. Sure, that's going to save you whatever, $100 a month. Okay, so you saved an extra $1,200 or $1,200, right, for the year by not buying coffee at all ever for an entire year. Well, that's only $1,200. It's not really going to get you far. So it's a lot easier to earn that extra little bit of income. To earn $1,200, you could go do some side jobs and make that in, a couple weekends or whatever.
Yeah, right? I mean, you don't have your restaurant anymore, but
exactly.
work for you to be a server and make some. Yeah, I guess exactly. People don't really think about that. I know, like, obviously working a 9-to-5 job is tough. Even longer than that, there are some people who are working 10, 12 hours a day and they don't have time to work that second job, or like they don't want to work on the weekends. But
the people that are probably working 10 to 12 hours a day are probably earning more higher income anyway, right?
That's
depending
true.
on your job, right? So then you don't have, it could just be as simple as working more or trying to pick up more with the job that you are already working or doing, right? So it doesn't have to be fully finding another career path and adding a second job or anything like that. But if your goal is to really get into property, it is hard in Toronto and the GTA. And no one's saying that it's not, right? So it does take a little bit of sacrifice on that budget, or figuring out a creative way to earn more money or buy property like with other people at its base, right? Because if you're looking, even if you earn $100K a year as a solo individual, you're still not really even qualifying, or just barely qualifying for the lowest like entry-level condo in Toronto, maybe, if that.
Yeah,
right?
So like $500,000-$600,000.
Yeah, like not even. You need to earn more than that to get up to that like $550,000-$600,000 range. Now, two individuals earning $60,000 or $70,000 a year, there you go. Now you have enough qualification power. But even a good six-figure earner, single solo person isn't even getting into those properties, right? So it does take a lot of sacrifice and getting creative with getting into the property.
Yeah, because I know there are also people nowadays who, maybe they do have parents who are willing to help them out, but I still feel like even if your parents help you out, there's still such a big responsibility for paying that mortgage. Let's say you're making $100,000 a year, or you're making $100K a year, and you can afford, your parents, someone helps you out to buy a property that's worth 600,000, 700,000. You still have to budget yourself even more to be able to afford that mortgage.
So whenever I work with with a client, when I do put together a pre-approval for them, it's a full budget breakdown as well, so they understand the carrying cost of the property. Because just because I didn't even touch upon mom and dad, bank of mom and dad. That's why I was trying to do all the topics
we can do both dad. Because some people need it. Yeah, some people don't need it.
It is the reality, right? So I was trying to kind of get into that topic of just doing it on your own, which is harder if you have mom and dad. But even if they're going to co-sign for you, right? Okay, they've boosted your purchase price up by $100,000, $200,000. But now, like you were saying, can you afford those monthly payments? Because it's not just the mortgage payment. And that's why when I do a pre-approval, break down the entire budget for them. Okay, this is the monthly carrying cost of the mortgage, the condo fees, the utilities that you're going to pay, the property taxes, like all these other costs that are associated with also owning just a condo, let alone then you're buying a semi or a detached home that actually has maintenance costs that can be in the thousands to tens of thousands of dollars, to factor in a safety net or savings on top of that. It's gonna be difficult. So even if that cosigner does boost you up to the purchase price you want, and you get a nice big gift or whatever from mom and dad to actually get into the property, are you going to be able to carry it without them also helping you every month on those payments?
Would you also be able to go to like a private lender or someone outside who may help you out? Because like we said, people don't want to be renting for their entire lives. Yeah. And let's say, like they could be doing that 9-to-5 job where they're making a decent amount of money, but it might not be enough, and they might need help from another source. And like you said, you could find a friend, you can find a partner who might help you out,
or even just renting out portions of the property, right? If it is a 2-bedroom or something, like actually renting out a bedroom and having to live with a roommate to cover some costs is the reality of a lot of people now. And with homes that were purchased 12 months ago or so on a variable or adjustable rate mortgage when it was super low, and now their payments have gone up $1,000 plus a month, it is a reality of some people that they have to do that, whether they're first-time home buyers or not. Even people that were, that were in their second or third home or in their forever home that they moved into a year ago are in a more difficult situation and having to do things like that. I think you asked a question there, alternative and like private mortgage lending. Those are really for alternative lending has a good place, and we can touch on that in a second. Private lending is more so like a last resort kind of, or a quick exit strategy type mortgage. Like you don't want to be sitting with a private lender, because even right now I'm working on a few private files. The interest rates are 9%, 10%, and you have fees on top of that of 1%, 2%, 3% of the mortgage amount in fees. So you can end up paying a boatload of money to be able to get into those mortgages. And there is some, not all lenders out there, but like some predatory lending that's out there where people want you to default on that mortgage so they can take the property and sell it. You're also going to have a significant amount of equity. So it's not realistic for anyone that is, a first-time home buyer. It's going to be, they're going to want, you can still get up to 80% loan to value, so having 20% equity in the property, but more and more so right now, especially on this market and the kind of the declining home prices, lenders want more skin in the game, right? So they're not even willing to fund up to 80. It'll be 70 or 65 or 60, depending on the area and where the property is located as well.
Okay. Yeah, because that's, like I said, something that other people out there may not know. I'm just trying to, find things to consider from all the different angles.
It is good because like people just don't realize like B and alternative and private and these terms that are out there. They're like, well, is that an option? I have people ask me that all the time, and I'm like, you don't want it to be an option for you, right? Like it can be in certain situations, or maybe you're trying to flip the property and you want a quick in and out, so we don't want to go through the paperwork and the banks and everything, because private lenders are just going to do it based on the value of the property, right? So if you're trying to get in and out quickly, or you need funds and then you're going to be able to refinance that private mortgage mortgage out back with a big bank or an A lender down the line, that can be a good strategy for getting in and out of that private mortgage as quickly as possible, but not a good long-term strategy.
Okay. All right. Yeah. And what would be the monthly costs, I guess, in general? Obviously, every situation is different, but for someone who owns like a $650,000 condo, do you know like what the mortgage rates would be?
It's really going to depend on the, your down payment that you have down there right now. And the actual type of mortgage that you are getting. Because we can jump on this, and this will get back to that kind of the monthly cost of carrying it, because this brings up a good point, is that when you place 20% down or more on a property, it will either be an insurable or an uninsurable mortgage. And that's going to depend if you go with a 25 or a 30-year amortization. So if your property is under $1 million, you place 20% or more on it, but take a 25-year amortization, it's going to be an insurable mortgage. So it's not insured because an insured purchase is less than 20% down, and it's not uninsurable because you've taken a 25-year am. It's kind of a sweet spot where you're going to get better interest rates. So it's kind of contradictory to people's mindset here, because the less money you put down, so if you get an insured mortgage, less than 20% down, less than $1 million property, you're going to get the best interest rates out there, the lowest interest rates. Whereas people are like, well, that's weird. You're putting less money down, and the banks are going to basically give you a discount because it's backed by that mortgage default insurance, which is the insurance that protects the lender, but you basically pay for it by tacking it on to your mortgage loan. So when people that put 20% or more down on a property and they do a 30-year amortization, they don't have the ability to get that insurance, the default insurance that protects the lender. So the lender actually charges a higher interest rate for that. So it's kind of, just a little contradictory thing that always comes up. They're like, well, I'm putting, 30% down or whatever. Why do I have a higher interest rate than this guy who's putting 5% down on a $500,000 property? That's the reasoning. So if you're looking at $500,000 mortgage right now, again, depending on whether it's insurable, you're looking at anywhere from a 4.5% interest rate to 5.5% type deal. So vastly different there, around 3,000 plus. So it's pretty expensive to be able to carry any mortgage right now. But that being said, as well, the strategies that you can put in place to help you pay less in the long run on your mortgage right now would be considering a short-term fixed rate. So
yeah, because I've heard people should be doing like 1-year mortgage, 3-year mortgage, 5-year mortgage. Those are probably the best options right now with however our market is.
Yeah, so a couple of different perspectives on that. So the 5-year mortgage, a 5-year fixed rate, a bank and a lender is always going to push onto people because the banks make the most money on that.
Of course.
So that's the reason that
it's like anything, right?
Yeah. So the 5-year fixed rate is actually what is always going to be pushed the most. And that's one, because the average mortgage is broken about 3.8 years into the term, right? So the banks know this, that the average mortgage actually doesn't last 5 years. That's because people sell, they move, they refinance, they do whatever, and then the bank makes money on that break penalty. So that's why they always push that 5-year term. That's why you're always going to get the most favorable rate on paper on a 5-year term as well, because they're going to make it look more attractive. You want the lower interest rate, take this, but in the long run, you're going to end up paying more money for it, right? So right now, a lot of my clients, I'm looking at a 2-year fixed rate. And that's because of the kind of the trajectory of where we think the interest rates are going to go, or what the economists are saying, and when they're going to start to kind of come back down the other side and start to drop. It's likely going to be in a 2-year period that you're going to be renewing into a much lower interest rate environment. So that's the reason. Now, the 2-year fixed rate, though, that's a conversation I have to have with clients because it's higher, right, than the 5-year. So they're like, well, people are only trained based on the media and the news and what's out there and all the branding, and on the side of every bank is like lowest interest rate, 5-year fixed, take this. That's the most important thing. Right. But you really have to plan for the long run with a mortgage. It's not a 1, 2, or 5-year thing. It could be a 25 or 30 year or your whole life, depending on what property it is you're buying.
Yeah, that's why it's so important to speak to someone like you. Because, there are people, who will speak to the bank, but I feel like speaking to an actual mortgage broker itself is probably better because you'll get better expert advice.
100% better.
Well, not kind of plugging you here, but
no, it honestly is, because and this is the most, I explain this every day when I talk to new clients as well, or new people. It's that, if you walk into TD Bank and talk to the TD mortgage specialist, guess what? They're going to offer you a TD mortgage and their products. They're not going to be like, hey, Scotiabank down the street has a really good promotion. You should leave here and go talk to that guy. Yeah. But that's what we can do as a mortgage broker, right? Is look at all of the sort of different options across the table. And then look at those lenders that you don't see every day. And they're monoline lenders, is what they're called. And they just do mortgages. So they don't deal in bank accounts and like lines of credit and credit cards and trying to push life insurance and property insurance and everything else that the bank's going to try and kind of throw at you. And oftentimes they'll offer those better rates on those insured and insurable products that I was talking about than the banks will. But people don't know that because they don't walk in. There's not a lot of MCAP or CMLS or Strive financial offices around. I'm sure you might not even know of any of those.
No, I actually don't.
So it's like those are the places that may, offer better alternatives to people, but they're not, they deal directly with mortgage brokers, right? Okay. So that's what we have access to as well.
Okay. Oh, that's kind of cool. Like, I don't know. I feel like so many people, like, they know about this stuff, but they don't know about this stuff. Like they'll go out and they'll listen. Obviously, like, what a mortgage broker is, but the amount of people who are actually reaching out, I'm curious as to the percentage of people who are going to a mortgage broker versus the people who are going straight to a bank.
So I don't have, I remember the stats previous. So the States is actually ahead of us on this. The US, the majority of people actually use mortgage brokers. I think it was something like 80% of people use mortgage brokers first, didn't even go to the bank. They just get the opinions from them. Canada and Canadians in general, a little bit more conservative. They like working with that bank that they've been with for 20 years. They think that they're going to hold them tight and protect them throughout all of their purchases and everything, which is often not really the case. They're not offering the best rates and things to a client, even if they've been there for 20 years, until maybe they speak to a mortgage broker. Then they try and go back and fight for their business and go back and forth. But at that point, it's like we've probably already beat them in a bunch of other aspects. But I think it was Canadians, it was something only like 40 or 50%. This is going back a couple of years, so the stat may be not fully accurate. I think it's getting better and better, and more people are more educated in talking to mortgage brokers now, just from the amount of information that's out there and social media and everything else.
And seeing you on TV and whatever.
That's it.
Helps you out a little bit, right?
Exactly. So getting some credibility out there, but yeah, it's definitely, I think it's becoming more and more so that people are going first. And it's also the job of the mortgage broker connecting with people like yourself and connecting with realtors and creating those relationships, because then we're going to get the deal done better together. When you send someone off to the bank or to do their own financing or mortgages, it can just be like ghost town. You never hear from anyone what they're doing over there, what's actually happening, where we have constant communication. There's certain realtors, that I work with that I'm talking to 4 or 5 times a week because we're working on a bunch of different files and clients together and walking through everything, right? So that creates that symbiotic relationship there. And then if you add a good, real estate lawyer in there, and I work with a lot of financial advisors and accountants, and it becomes like now you have these whole all independent services
big network
working
of
for
people,
you. As opposed to the bank that's only, again, just going to be pushing, their products, their financial advisor, because they're going to make money off of that. And that's their end goal.
And it's good because it makes both of us look good.
Yeah.
Right. For me as a real estate agent, if I know people who are, someone who's a mortgage broker, someone who's a financial advisor, someone who's a real estate lawyer, and have all these people come together, and you come to me as a client, and I'm going out and I know all these people that I can send you off to. It's so much better. And same thing for you, right? Exactly. You have someone who wants to come to you for mortgage, but maybe they don't have an agent, and then you find a real estate agent, and you have all these other people, like you said, in your network.
Here's a lawyer, start the process with them, and get everything working together. And the majority of us are all working commission based, right? Or getting paid when the deal funds or closes correctly and efficiently and on time and everything. So that's the biggest big takeaway as well. It's you go to the bank, they're salaried employees. They don't really give a crap if it does go through or not. Oh, something didn't work out with the financing.
Whatever.
That sucks. It's hopefully we can fix it. Or they're going to say, okay, we probably should go to a mortgage broker now to see if we can save the file and do something with it, right? So that's definitely a big factor too. We're working for the client and in their best interest.
Yeah, putting in 100%
fiduciary duty, if you want to use
the due diligence and all that. Yeah. No, it's honestly, I think it's great, the fact that we can connect because we're such similar fields. you know, it's because like we don't compete against each other. We compete.
Yeah.
You know, we're like with each other. Like we're trying to help each other out, right? Instead of like you said, like that boss at whatever bank who is just paying you a salary, and you know, if a guy comes in and they want to buy a place and you know, it doesn't work out, whatever,
you're more of a number rather than, you know, a client that we want to work with for life. That's my goal anyway. With every client, it's like get you into your first home, and then you move up, and then buy an investment property until you know, move into a retirement home, and we'll figure out all your different ways
then
to
you
do it.
Go to, but then you go to the kids and the grandkids.
Yeah, exactly.
And, you know,
right.
it's a
so
whole...
like that's my goal is when I'm working with someone, it's not just like run and gun on to the next deal, right? It's to work with the client for life and create that relationship.
Yeah, and that's exactly why I'm in real estate too, right? It's the same thing. It's, you know, you build the relationships and you maintain them for life. And I think that's just like, obviously I'm sure it's the same for you. That's who you are as a person too. Just, you know, like you like doing that, especially because you're in the hospitality and you know, running a restaurant. You want to build that team of people to, you know, help your restaurant succeed and help people, you know, come into the place, enjoy it, like it, and then come back, right?
Yeah,
so
exactly.
It's
and refer your friends and tell all your friends.
Come on in.
It's all the same, right? It's every business has that, you know, those same similarities in it, right?
Yeah, as long as you're making good food, I guess that's
that's it. Now I make good mortgages. That's it.
There you go. Yeah, just building it together. So yeah, I guess we can also touch on like the mortgage rates and what your predictions are for the future, because right now, you know, mortgage rates are hiking.
Yeah,
and you know, there was another meeting a week or two ago, and they brought it up.
January 25th was the last one. March 8th, we have another one coming up. So yeah, I'll do a quick kind of deep dive. This is an efficient deep dive here into mortgage rates and my predictions for the future. So following a lot of the trends of the different economists out there and everything, that's really how we can kind of best get our information, right? And seeing what the Bank of Canada is doing, and then really looking at all the reports, all the monetary reports that come out, right? So the most recent one was a jobs report that came out last week from whenever we're doing this podcast or whenever this airs. It was 150,000 new jobs were added in the month of January. That's an estimate. But good news for the economy is bad news for interest rates, because then the Bank of Canada says, well, everything's still doing fine. We got to hike more interest rates up so people stop spending, so the job growth slows down, everything slows down. Now, just based on this report, I don't think that the Bank of Canada is likely to increase on March 8th again. They've said they're going to pause. They keep telling us they're going to pause. So I think it'd look real bad on them, basically, to just renege a week or two later. But this does signal that it is likely that we'll see another small rate increase by the summertime. So there's about a 70% chance right now, so most economists are saying, that we will see one more small rate increase before we start to see a plateau or come back down the other side. That also got pushed back. So a lot of people were saying, and myself included, and based on the information that I could gather, that we may see at the end of 2023 rate cuts actually happening. It's likely that's going to be around the start of 2024 that we start to see rate cuts. And it's not going to be as aggressive as we saw them increase by 1%, full increases like that. It's probably going to be a slow and steady kind of decline throughout 2024. A good statistic, and I'll leave us on this, or to look at historical data in the States and Canada, because it's good to look at the States. They just have more people, more data points to go off of. That every inflationary period where we saw inflation kind of skyrocket and then interest rates follow after, whenever they hit the plateau, it took about 2 years, so 24 months from the plateau, for the prime rate to go from where it was to cut in half. So right now we see 6.7%. If we are at the height of those interest rates as of the next rate increase or the last one that just happened, it should be 24 months where we see the prime rate back around, say, 3.5%. Right?
That's really good.
Which is more manageable. And that's happened for over the last 30 years, the last 3 cycles of inflation and interest rates going up and down. It was almost that exact. Interest rate hits the peak, plateaus for about 12 months, decreases for 12 months, and is at a half of where it was 24 months after the last rate increase.
Yeah, that's good news. I mean, listen.
So hopefully the trends stay the same. The historical data checks out, but that's the reason as well for putting people in those 2-year fixed rates, right?
Because then we're seeing hold them for
24
2 years,
months. Now, hopefully, we're going to be renewing back into a much lower rate.
Right, and you can go back to a lower. Lower rate.
And then at that point, we reevaluate: does it make sense to go variable, adjustable, 5-year, whatever, at that lower interest rate? Right now, it doesn't make sense based on what we have, the data points that we have.
So you said that you recommend a fixed rate over a variable rate.
I would say right now for stability, or if you're more willing to take the risk and you want to ride the wave of the kind of potential other increase and then decreases, maybe an adjustable or variable rate. It also depends on your overall situation and your plan to what to do with the property, right? If you're going to stay there long term, say do a 2-year fixed rate because you're guaranteed going to be there for 2 years, as long as that's part of your life plan. Reevaluate then and then see kind of where you're at.
Okay. Yeah, because, some people are going in. I've spoken to people who have done fixed rate. I've spoken to people who have done variable rate. And, some of them regret doing one and regret doing the other because the timing is so weird, right? Like you never know.
You never really know what you're going to do for certain. But we do know, based on statistics, that the average mortgage, as I said, was broken 3.8 years into that term. So if we know that as a statistic, then why take a 5-year fixed with that uncertainty? And anyone taking those 5-year fixed with lower interest rates right now, say it's 4.5% or 4.8% on a 5-year fixed, in 2 years when the interest rates drop and you want to refinance, the bank's able to manipulate what's called their posted rate, which is going to create an astronomical penalty if you want to refinance. So all those people that are taking that, good interest rate right now at 5 years, if interest rates drop back down to say the high 2s, low 3s, and they want to refinance, it's going to almost be impossible for them. They're going to have to ride out that full 5 years, or if they want to pay $20,000, $30,000, $40,000 out of pocket, or add that onto the mortgage.
I don't think they're going to want to do that.
Exactly. Yeah. They're just going to have to ride out those higher payments for longer. So that's also something the banks will inevitably do. They'll make it very difficult to break a 5-year mortgage in 2 to 3 year time.
Okay, that's super interesting. Yeah. So we're actually, I think we're close to the end right now. I was going to leave you with one question, and that's, as a home buyer, I guess we already spoke about like the best strategy, but what's some advice you would give to somebody who is a first-time home buyer who's looking to buy a property, let's say, I don't want to say right now, but in the next year or two?
So definitely if you can afford the monthly payments, right? Like I said, on that budget, go over the budget and the monthly payments, and whatever you qualify for, it would be a good time to get in, right? Because I'm not going to say date the rate, marry the house, or whatever the phrase is that everybody says. But, it is true that if you can get in now at a price point that's lower, you can't change that original purchase price and that original mortgage amount that you start with, right? So if it's lower right now, if we're seeing that the prices have gone down over the last 8 to 12 months, which they have, and you can afford those monthly payments, it's better to do so. And you have even a little bit of a down payment, you can qualify for that purchase. Just get pre-approved, get qualified, start looking at the properties, and I would say jump on the opportunity now, because if you do wait to save, like I said, trying to save more money rather than just earn more money to put into that is very difficult, and you're going to be kind of just falling behind if prices start to go back up when interest rates start to drop, right? So if they kind of plateau for a bit and start to go back up, it's just going to be more difficult to save for that minimum down payment. You're always going to be, behind. So if you can qualify, if you can afford the monthly payments, or however you can, teaming up with someone, doing whatever you can to get in as soon as possible.
Okay. Well, thanks so much. Yeah, Zach, I really appreciate it. I think that was a great conversation, a lot of good insight. And I'm going to look back at this podcast in 2 years and see if your prediction is right.
Well, hopefully I'll be back before then, and then I'll just adjust my. No, I'm just kidding.
Maybe we'll take you on in like a year and see what your predictions were, and
that'd be awesome.
Coming back and seeing what the future holds in the future. So But anyway, thanks so much. Where can people find you online? Because I know that.
So Mortgages with Zach is my Instagram there. Zach at immaculatemortgage.ca is email, 416-275-3649. Give me a call anytime. Happy to chat about your specific situation when it comes to mortgages.
All right. Well, thanks everyone, and we'll see you next week.